JP Morgan just closed their short position in silver at what looked like the exact market bottom on Friday. And now they're pinning the whole thing on the Fed chair story. So what on earth just happened in the silver market? Because it wasn't normal. It wasn't orderly. It didn't feel like price discovery. It felt like a trap door opened. And what really gets me is that the mainstream coverage is telling you the neat, clean version. The version that fits in a headline while ignoring the mechanics that actually force markets to break. If you hold silver, gold, mining stocks, or even precious metals ETFs in a retirement account, you deserve the full story and the actual chain of events, not the bedtime story. So, here it is. First, I asked my editor to put the screenshot on the chart so you can see it with your own eyes. The positioning shift happens right into the low. That's item number 1. Then we had the wonderful coincidence of the London Metal Exchange going offline on Friday, one of the most important venues on earth for industrial metals pricing and hedging, and then almost comically, HSBC, a major short participant in the London market, also had systems issues at the same time. Meanwhile, over in Chicago, COMEX through CME Group raised margin requirements right when the market was stretched, crowded, and leveraged. And the timing, they waited until Asian markets were closing into the weekend because Asia is roughly 12 hours ahead of the US East Coast. And then the market gets rattled with a shiny new narrative about a Fed chair shift. Now, are these proven coordinated actions? I can't prove intent. I'm not in the room. But I can lay out the sequence, the incentives, and the mechanism, and you can decide whether you believe in coincidences because the outcome was not a small move. We just saw one of the biggest silver crashes in decades. A brutal flush that either becomes an incredible opportunity or it scares people out right before the next leg. If you want to get better at spotting these opportunities, you can do that with the Buffett Academy. You'll get exclusive weekly videos showing the exact stocks I'm buying and why. Plus, the Millionaire Blueprint, a repeatable framework to building wealth and investing skill. It's linked in the pinned comment. So, let's step back. On Thursday, silver hit about $120. On Friday, it crashed to roughly $78. That's a $42 dump. About $35 in basically no time. It was the worst day in silver since 1980 by many measures. People used to compare these events. Gold fell hard too, down around 12% at the lows. And across the complex, you had an enormous amount of market value wiped out in a blink. Mining stocks got absolutely torched. The big miner ETFs were hit. Silver miners hit even harder. Companies didn't suddenly lose the metal in the ground. The assets didn't vanish. But the paper value got obliterated because of how positioning and leverage get forced out when the plumbing is turned against the crowd. And here's what you need to understand. Mainstream coverage is acting like this was simply a reaction, like markets politely repriced based on a new piece of information. That's not what this looked like. This looked like an engineered flush, or if you prefer softer wording, a mechanically forced liquidation event that benefited the player's position to survive it. And a month ago, I made a video about the December silver crash when we hit $84. I laid out a pattern, 1980, 2011, 2025. Same playbook, same mechanisms, same types of players, similar outcomes. Some people watched it, some people ignored it. Well, they just did it again. But this time it was bigger. And if you understand the trigger and the tool they used, it actually strengthens the underlying thesis rather than weakening it. So, I'm going to break down 3 critical things for you quickly, because it's freezing out here and I'm trying not to drop my camera into the snow. First, what actually triggered the massacre and who actually won. Second, why this crash didn't solve anything about supply and demand. If anything, my previous thesis is stronger now. Third, what moves you might consider from a risk and positioning standpoint. Not advice, not do this now, but a way to think so you're not just being whipped around by noise. Now, put the move in perspective. Silver hits the high, then it's down 35% in a heartbeat. Gold drops hard too. And the public narrative becomes it was the Fed chair story. Okay, was that a catalyst? Sure. A match can light a fuse. But it wasn't the bomb. The bomb is the mechanism that forces liquidation, the thing that turns normal selling into a waterfall. And that's where margin comes in. Because here's the dirty secret of modern markets. The crowd doesn't get taken out by being wrong. The crowd gets taken out by being leveraged at the moment the rules change. I went digging through CME silver margin data, and I genuinely couldn't believe what I was seeing. I searched around and found almost nobody talking about it in a serious way. And that's insane to me because this detail is not a footnote. It's the lever that can move the entire structure. And before anyone clips this and screams conspiracy, let me be clear. I'm not claiming I have proof of illegal behavior. I'm saying the pattern is consistent, the tool is known, the incentives are obvious, and the results keep repeating. So let's walk through the playbook. We've now seen this structure multiple times. In 1980, you had a speculative mania and the Hunt brothers story. Silver ran hard. Then, the exchange implemented rule changes that restricted buying and effectively forced liquidation. Silver collapsed massively. The little guy got kicked out. The big guy survived. In 2011, you had the post-financial crisis precious metals run. Silver hits around 49ers. CME raises margin requirements repeatedly, multiple times in a short window, and you get a violent flush. Same mechanism. When margin rises, the leverage crowd must either add cash or sell. If they can't add cash, they sell, and the selling forces more margin calls, and that forces more selling. It's a domino chain. Then December 2025, silver hits $84 during thin holiday liquidity. Margins get raised again. Silver dumps. And I said at the time, if you keep seeing the same levers pulled in the same moments, it's not random, it's a system. And then January, silver hits $120, and then the story drops. Trump nominates Kevin Walsh as a new Fed chair, a traditional hawk, the kind of name that suggests less money printing and tighter conditions. Tight money is bad for gold and silver, says the headline logic. Fine, that's the match. But then the market does what a crowded leverage market does. Stops get hit, liquidation kicks in, algorithms pile on, and the trapdoor opens. And it's very convenient when that happens to coincide with outages in key venues and a margin hike that makes it dramatically harder for the marginal participant to stay in the game. Again, I can't prove intent, but I can tell you the mechanism is real. Now, what is margin really, and why is it such a weapon? Silver trades in two big worlds, the paper market and the physical market. The paper market is futures, mostly comics. In the paper world, you're not buying silver bars. You're buying a contract, a promise of exposure, and you do it with leverage. So, you might control $100,000 worth of silver with $10,000 posted as margin. That leverage makes moves bigger. It also makes you fragile. And here's the key. The exchange can change margin requirements. They can say, actually, we don't want 10% anymore. We want 20% or 30% or 40%. And when they change that requirement, they force every leverage participant to make an immediate choice. Option 1, deposit more money right now. Option 2, sell your position right now. If silver is ripping and everyone is already maxed out on margin, most people don't have extra cash sitting around ready to wire in, so they sell. And that selling pushes the price down, and that triggers more margin calls, which triggers more selling, which triggers more forced selling, and the waterfall feeds itself. This is why these moves look like a failure. They look like panic. But a lot of that panic is mechanical. It's compulsory. People are not choosing it. They're being forced. And if you want a cynical way to put it, margin is a way to legally change the rules of participation in the middle of the game. So what happened Friday in the paper world is leverage got flushed hard. Some leveraged silver ETFs got obliterated down the kind of numbers that teach painful lessons fast. And I'll say this bluntly, leveraging something like silver into a crowded trade when you know margin can change is madness. That's not bravery, that's volunteering to be the exit liquidity. Now the physical market is different. Physical silver is bars, coins, real metal. It moves slower. It's driven by availability, real demand, real supply constraints, premiums, and logistics. And here's the part that matters. You can pressure paper price, but you can't print physical silver into existence. So, if there's a real supply problem, a paper flush doesn't fix it. It doesn't create new silver. It doesn't suddenly reduce industrial demand from solar panels, electric vehicles, and data centers. It doesn't change the fact that a lot of analysts have been tracking persistent deficits in available supply. In other words, paper can reset sentiment. Physical eventually resets reality. And that's why, in my opinion, this crash actually strengthens the thesis rather than destroying it. It looks like the paper market is being stressed and re-entered by force. And as paper participation gets punished, physical becomes the only thing that matters long-term. Now, one of the smoking guns for physical tightness is premium behavior, what people are paying above the quoted spot price in places where physical demand is intense. The premium in Shanghai, for example, the amount buyers pay above paper price, has been very elevated. That's not what you see in a market that is overflowing with easy supply. So what does this mean going forward? Well, historically, the aftermath depends on whether the move was purely speculative or whether it collided with real fundamental demand. In 1980, you could argue it was heavily speculative. When it popped, it took a long time to recover because the why wasn't industrial necessity. It was mania and a corner attempt. In 2011, it was partly a fear trade. Fear fades, markets move on. The recovery took time. In December 2025, there was real demand underneath, and the recovery was faster. It didn't take years, it took weeks, and then it ran again. So, the question now is this going to behave more like 1980 and 2011, long recovery, or more like December, faster recovery? I personally lean toward faster recovery if the physical squeeze remains real, but what I can tell you is this. You will likely see more of these events. A former London Metal Exchange market maker, one of the guys who actually lived inside the casino, has said for a while that in a structurally stressed market, you can see 20–30% dumps that are not fundamental. They're mechanical. Until the market reaches a point where silver demand is meaningfully reduced, whether through substitution, technology changes, or price-induced demand destruction, volatility is part of the package. And that brings us back to what the mainstream narrative is missing. They're saying Kevin Walsh crashed the market maybe as a headline, but the deeper truth is, Walsh was the match. The fuel was leverage. The accelerant was margin. The outcome was forced liquidation. Because when the dollar spikes, metals priced in dollars often drop. A hawkish Fed narrative can strengthen the dollar. And if the metals trade is the most crowded trade on the planet, if everyone and their grandmother is long, if retail is in, hedge funds are in, institutions are in, then you don't need much to trigger a liquidation event. Crowded trades don't end gently, they end violently. And once the liquidation starts, algorithmic systems don't think. They respond. They hit stops. They pull bids. They chase momentum. They amplify the cascade. And here's the part that should make you pay attention. Brokers and exchanges have visibility into positioning, leverage, and liquidation levels. They see where risk is concentrated. They know where forced selling is likely to kick in. Am I saying that's abused? I'm not claiming that. I'm saying the visibility exists, and that alone changes the game for the participant who doesn't have it. Now, later in the Friday chaos, there were reports and headlines flying around about strategic metals policy, about support being cut, about this or that being ending. Some of those claims were disputed, some officials called things misleading. But markets don't wait for clarifications. Algorithms react to headlines. The cascade was already in motion, and once you're in waterfall territory, truth arrives late. The tape moves first. So again, put it together. A hawkish Fed chair narrative, a stronger dollar impulse, a crowded metals trade, high leverage in paper, a margin hike that forces selling, headline turbulence, outages, and thin liquidity at the worst possible moment. You don't need a cartoon villain to see how that recipe produces a crash. You just need to understand mechanics. Now I want to slow down and make the margin weapon crystal clear, because if you take nothing else from this video, take this. Margin is not a side detail. Margin is the steering wheel. When the exchange raises margin, it removes the weakest hands. Not because they change their mind, but because they can't fund the position. That's why technical analysis often fails during these events. People draw lines and say support here, resistance there. But when liquidation is forced, those levels don't matter. The selling doesn't stop because a line is drawn. The selling stops when the forced sellers are done, and that means if you're trying to trade the exact bottom with leverage, you're playing their game. And in their game, the house always wins. So, what do you do with this? First, you stop confusing paper volatility with physical reality. Second, you stop letting headlines trick you into thinking you understand causality. Third, you get serious about risk management, which is boring until it saves you, because the #1 risk management rule is position size. If you're in something so big it messes with your sleep, you're too big. If a 10% move ruins your week, you're too big. If a 30% flush wipes you out, you weren't unlucky. You were over-levered. Now, I'm going to talk about moves you might make. I'm not giving you financial advice. I'm giving you a framework. If you believe the physical thesis, you might prefer exposure that doesn't get margin called out from under you. That could mean less leverage, longer time horizons, or instruments that don't mechanically explode under force volatility. If you don't have the stomach for silver volatility, gold historically tends to be less wild. And Friday showed that silver down monstrous, gold down heavy, but not the same kind of carnage. If you're in miners, understand miners are equities. They get hit by equity liquidity events too. They can be great in the long run, but in a flush, they often get punished regardless of fundamentals. That's not a moral statement. That's a correlation and liquidity statement. And if you're holding any of this in retirement accounts, 401k, savings, bonds, cash, broad ETFs, you need to understand that we're in a world where the plumbing matters more than most people think. The next few years may be defined by the biggest monetary and market regime shifts most investors have lived through. What you do with information like this can matter more than being right on direction, because preserving wealth isn't about predicting the next headline. It's about building a structure that can survive the forced moves. Now, before my hands freeze off, let me tie the story back to the beginning, because I started with JPM the bottom and the Fed chair excuse. When you see a market bottom ticked perfectly, you should ask, who had the ability to buy when everyone else was forced to sell? Who had the balance sheet to absorb panic? Who benefits from a margin-driven flush? Usually, it's not the retail trader. Usually, it's the participant who can survive the rules changing. And that's why I want you to stop consuming the mainstream narrative like it's a full explanation. It's not. It's usually a label slapped on a move after the fact. The real explanation is incentives and mechanics. And if you want to learn pattern spotting, not as astrology, but as a practical how markets actually behave skill, I'll run a live session for you guys on Saturday. There'll be a link below. Free seat, no nonsense. It's going to be in depth. It'll open your eyes to how these setups form, how they trigger, and how you build a plan that isn't based on vibes. Secondly, we have a daily and weekly free metals newsletter link below as well, and a bunch of you are already on it. It's got humor, but it's also grounded in data. And listen, the point of all this isn't to make you angry. The point is to make you dangerous. Dangerous in the good way. The way prepared people are dangerous. They don't panic. They don't get shaken out by the obvious trap. They don't gamble with leverage when the exchange has a legal lever to pull against them. So, let me summarize the 3 critical points one more time in plain English. The trigger wasn't just a hawkish Fed chair headline. The trigger was leverage meeting a margin hike in a crowded trade. The crash didn't fix the physical supply problem. It flushed paper and sentiment. And the move you make next should be based on structure, time horizon, position size, and whether you can survive volatility without being forced out at the worst moment. That's it. That's the real story. If you want to build real investor instincts, the kind that spot opportunity and chaos, join the Buffett Academy. You'll get exclusive weekly videos, my decision process, and the frameworks for thinking like a top 1% investor. It's linked in the pinned comment below. If you got value from this, share it, because very few people understand how this works, and even fewer people are willing to say the quiet part out loud. Markets don't just move on news, they move on positioning, leverage, and who gets forced to sell. Take care of yourself out.